Hi, I'm Jalen, an associate on the customer experience team. Today, I'm answering your question about Robinhood's options risk check process. This is Robinhood Answers. Managing options positions, especially near expiration, requires more than just market awareness. It also means making sure your account can handle what happens if your contract is exercised or assigned. At Robinhood, we run risk checks to help protect you and the firm from potential outcomes that could leave your account overdrawn or holding a position you didn't plan for. So, if you're planning to hold an option through expiration, make sure you have enough buying power or shares to support the trade. If not, we may take action in your account by closing out your position early to help you avoid unintended consequences. Every option contract has an expiration date. That's the final date it can be traded, exercised, or allowed to expire. If you hold an option that's in the money by 1 penny or more at expiration, it will be automatically exercised by the OCC. Exercising a call typically means buying 100 shares per contract at the strike price. Exercising a put typically means selling 100 shares per contract at the strike price. To complete either transaction, your account must have sufficient cash or stock. Meanwhile, if you sold an option, you face assignment risk. The buyer can choose to exercise the contract and you'll be obligated to fulfill it. Being assigned on a short call means selling 100 shares per contract at the strike price. Being assigned on a short put means buying 100 shares per contract. Remember, for equity and ETF options, assignment can happen at any time, not just at expiration, and not only when an option is already in the money. Contracts with a chance of expiring in the money, especially around dividends, earnings, or high volatility, may be exercised early. Importantly, if you don't have the necessary funds or shares to support either exercise or assignment, Robinhood may take action and close your positions early through our risk check process to manage risk and help prevent unintended outcomes. As expiration approaches, especially during the final 30 to 45 minutes of market hours, Robinhood runs a risk check. We look at your account and ask, can you afford to exercise or be assigned to this contract? Meaning, do you have enough cash or enough shares to cover the resulting trade? If the answer is no, and the position is in the money or at the risk of being in the money, we may close the option contract for you before it expires. In some cases, especially in fast-moving markets, this might happen outside that 45-minute window. It all depends on market conditions and the potential risk to your account. The simple answer is to help manage your risk and ours. Let's say you hold a call option to buy 100 shares of stock at $100 and the stock is trading at $110 as expiration approaches. If the option is exercised, you'd need $10,000 in buying power to purchase those shares. But if your account only has $2,000, you wouldn't be able to complete the trade, resulting in an $8,000 account deficit. Rather than letting the option expire worthless or putting your account into a shortfall, Robinhood may sell the option on your behalf. The same logic applies to put options. Imagine you hold a put giving you the right to sell 100 shares at $50, but you don't actually own the shares. If exercised, you'd be creating a short position, exposing you to significant risk. In either scenario, the stock could gap up or down when the market reopens, potentially increasing your losses well beyond the original risk of your options trade. As expiration approaches, managing your options positions becomes especially important because if you hold a contract through expiration and it's in the money, it may be automatically exercised if you're long or assigned if you're short. That could result in a stock position you didn't intend to own or an obligation to deliver shares you don't have. To better manage that risk, consider taking action before expiration. That can mean closing your position ahead of Robinhood's risk check or rolling the contract to a later expiration date if you want to maintain your exposure while controlling the timing. Also, be aware of dividend risk, particularly if you're short a call option that's in the money. The closer a stock is to its ex-dividend date, the more likely it is the call holder may exercise early to capture the dividend, which could leave you assigned sooner than expected and on the hook for paying the dividend. One last note. If you're trading index options like SPX, NDX, RUT, VIX, and XSP, these are automatically cash settled if they're in the money at expiration, either in the morning or evening, depending on the contract. Since they don't involve delivering or receiving stock, Robinhood's risk closeout process doesn't apply to index options. Thanks for watching. Don't forget to like, subscribe, and hit the bell so you're notified when new content drops. If you have more questions, check out the Robinhood Help Center or reach out to customer support. We're here to help. This was Robinhood Answers. I'm Jalen. See you next time.